let's move into the other goal of asset liability management, which is protecting owners' equity, protecting the capital of a bank. Very important to protect the capital of a bank from a legal point of view, from a regulatory point of view, from a business point of view. All right, GAAP management, what we just looked at, is focused on the bank's profit margin, on the income statement, on interest income and interest expense. This is great, but it ignores the impact that changing rates directly have on the value of assets, on liabilities, and then indirectly on a bank's owner's equity. So changing rates don't directly affect owner's equity. They affect owner's equity because they affect assets and liabilities. Okay? The issue is that rising market rates cause the value of assets and liabilities to decline. Okay? Interest rates go up, prices come down. Some bank assets tend to have longer terms than liabilities. That is almost universally true, where bank assets are longer term than bank liabilities. Rising rates cause the value of assets to decline more than the value of liabilities because the terms for assets are longer, and longer term securities are more sensitive to changes in interest rates than shorter term securities are. Okay? So the longer the term, if rates go up, prices come down. The longer the term, if rates go down, prices go up. So if you think rates are going to go up, you want to have short-term assets. If you think rates are going to go down, you want to have long-term assets. Okay? So if the value of your assets declines more than the value of your liabilities, your equity will contract. That's what happened in 2009. The value of assets dropped not because rates went up so much, but because they had to write assets off because they invested in a bunch of bad assets. Since banks are highly leveraged, meaning there is typically only a 10% difference, I think 11% is the capital requirement, between the value of assets and liabilities. Okay? So assets minus liabilities is equal to 10%. That means the margin, that means a bank has $100 million in assets and only $90 million of liabilities, which means they only have $10 million of equity. So all it takes is a 10% decline. All it takes is a 10% decline in the value of your assets to wipe out your capital. And that's what happened. So what do you do then? Well, you have to raise capital. Well, how do you raise capital? You sell stock. You issue new shares of stock. That's one way. Remember, there are two line items in capital. One is contributed capital, that's selling stock. The other is retained earnings. Okay? So the Federal Reserve dropped short-term rates in order to steepen the yield curve so that over a period of 3 or 4 or 5 years, banks' profits would increase and they would retain those profits in addition to the stock that they sold, and they would rebuild their capital. And that's what happened. Okay? So GAAP management, since GAAP management ignores owner's equity, we need a tool that will help us understand and manage the impact that rising rates have on owner's equity. This tool is a concept called duration, and we cover this in investments. We don't cover it in ManFin. Okay? We don't have time. Duration is a measure of maturity that considers the timing of cash flows. When will cash flows come in? How much will the cash flow be, and when will it come in? Okay? It measures the average maturity of a stream of future cash payments. Okay? Like on a bond or a loan. Duration also tells us how the value of an asset or a liability will change in response to a change in interest rates. Okay? Once we know the duration and we can calculate duration, then we can see how assets and liabilities are likely to respond to potential changes in interest rates. We're going to do that, okay? So this allows managers to control the impact changing rates have on the value of assets, liabilities, and owner's equity. We can forecast or project or model what if, okay? To minimize the impact of changing interest rates, we set duration for assets and liabilities as close as possible to each other. Once again, since we cannot forecast rates, we try to manage our sensitivity. We try to manage our risk. And the closer the duration is for assets and liabilities, the less risk and the less volatility we are facing. Okay? If duration is the same for assets and liabilities, then the values of assets and liabilities will change at the same speed in response to changes in interest rates. Okay? All right. Now I could show you a fancy formula to compute duration, okay, but it would just make your head spin. Instead, let's look at a table which shows us the calculations. Once you see the table, it's very clear how we calculate duration. Okay? So let's assume a bond or loan has a term of 5 years. The principal is $1,000. The interest rate is 10%. Okay? So this is what the table looks like. We have the period in which the cash flow is received. We have the amount of the cash flow. We have the cash flow times the period. And then we have the present value of the cash flow times the time period. And the discount rate is 10%. Okay? So we're going to get 6 cash flows. We're going to get 5 interest payments. And then in year 5, we'll have a second cash flow, which is our principal. Okay? So let's take a look. The first payment is at the end of the year. We get $100. It's 10% on $1,000. Okay? So the cash flow times 1 is $100. And then 100 divided by 1.1 to the first is $90.91. 100 times 2 is $200 divided by 1.1 raised to the second. $100 times 3 is $300 divided by 1.1 to the third. $100 times 4 is $400 divided by 1.1 to the fourth. $100 times 5 is $500 divided by 1.1 to the fifth. And then our sixth cash flow, but this is not the number of cash flows, this is when we receive it. 5 times 1,000 is 5,000. 5,000 divided by 1.1 raised to the fifth is 3104.61. Add up these present values, okay, and divide it by the 1,000. Okay? Duration is equal to the total of this divided by the 1,000, 4.17 years. That is the average maturity. Okay? Now I want to tell you something, that the higher the interest rate and the higher the coupon payment here, the shorter this will be. Okay? If this paid semi-annually instead of annually, this would be shorter. Okay? So the higher the cash flow and the more frequently you get the cash flow, the shorter duration is. So in the market, the longest duration bond you can buy is a 30-year zero coupon treasury. It is a treasury bond that matures in 30 years. You don't get your money back for 30 years, and in the interim, it pays no cash interest. Okay? It accrues, but it doesn't pay you. So the duration on that 30-year maturity is very long. It's 30. Okay? If it paid the same 30-year bond that paid a 5% coupon rate, would have a much shorter duration. If it had a 10% coupon rate, it would be even shorter. If it pays semi-annually versus annually, it would be even shorter. Okay? So you need to understand those relationships. But the duration, the average term to maturity, 4.17 years. What does that mean? How can we use that? Let's look at it. The important feature of duration is that it measures the sensitivity of the market value of financial instruments to changes in interest rates. So this tells us how a market price for a security or a loan will respond to a change in interest rates. Okay? So the percentage change in the market value of a financial instrument is equal to the opposite of the duration times the percentage point change in interest divided by 1 plus the beginning interest. And you're going, what is that? We'll take a look at this example, and it will be quite simple. In our example, we use the duration of 4.17 years, so we're going to put that right here. It's a negative because interest rates go up and bond and loan prices go down. Okay? Now, the beginning interest rate is 10%. That was the rate on the bond. If the rate rises 1 percentage point, okay, then here's our formula. The market value of the bond should change by, so first of all, we got rates that are going up. Rates go up, price goes down. If rates go down, price goes up. And it's going up 1 percentage point on a beginning balance of 10%. So let's take a look. So here's our formula, minus 4.17 times the percentage point change divided by 1 plus the beginning rate. So it's this, so we're going to do this first, then this second. 1 divided by 1.1, then we're going to multiply times minus 4.17, and we get minus 3.791%, and we'll multiply that percent times the $1,000 par value, or price of the bond, market price of the bond, market price of the bond, and we find that the bond will go down in price by $37.91. If interest rates go from 10% to 11%, this bond will go down in price by approximately $38. What will the market price be? It will be the current value of $1,000 minus $37.91, which is $962.09. Okay? That's how you use duration. The longer the duration, the bigger the change. Interest rates go up, the price goes down by more. Okay? Duration goes up if the term goes up. Duration goes up if you pay less often. Duration goes up if the interest rate on the bond at the beginning interest rate is lower. Duration goes down if interest rates go up. Okay? And duration will go down if you pay more frequently, quarterly instead of annually. All right. If the duration of the asset portfolio is greater than the duration of the liability portfolio, the value of the asset portfolio will change by more than the value of the liability portfolio. Okay? The risk here is that when rates rise, the value of the assets will fall more than the value of the liabilities. This will cause owner's equity to decline. The wider the difference between the duration of the asset portfolio and the duration of the liability portfolio, the higher the risk from rising rates. If the duration of the asset portfolio is less than for the liability portfolio. The duration gap will be negative, and the risk is that interest rates will fall. If interest rates fall, the value of liabilities will rise more than the value of assets, and owner's equity will decline. So it depends on whether your asset duration is longer or your liability duration is longer. Once again, you need to understand these are questions that will be on the exam. All right. To summarize the implications of a duration gap, if the gap is positive, meaning assets are longer than liabilities, a rise in rates will hurt owner's equity. A decline in rates will help owner's equity. If the gap is negative, a rise in rates helps owner's equity. A decline in rates hurts owner's equity. Since the dollar assets are greater than the dollar liabilities for every healthy firm, assets are higher than liabilities. A firm in technical default or bankruptcy is a firm where the liabilities are greater than the assets. So for most firms, the value of the assets is greater than the value of the liabilities. We have to adjust the duration gap because you have more money in assets than you do have in liabilities. So the speed may change at the same rate, but the dollar amounts will not. If the speed is the same and you have more money invested in assets, then your income will change faster than your expense. Your liabilities your assets will change more than your liabilities on a dollar basis, even if the rates change at the same speed. Okay? Because assets will change by a higher dollar value if they have the same duration as liabilities. So we have what's called the leverage adjusted duration gap. This is really cool stuff, folks. And this is stuff that you're only going to see if you go to work in portfolio management at a bank. But the bank, if you go to work at a bank, you need to be aware of what the bank is dealing with. So the leverage adjusted duration gap. So the duration of the asset portfolio minus the duration of the liability portfolio times total liabilities divided by total assets. Let's take a look at an example. Okay? Example. Total assets, 200 million. Total liabilities, 180 million. So what's total equity? 200 minus 180, 20 million. Okay? Which is 10% of assets. The asset duration, so we're giving you the duration, is 3 years. 3 years on 200 million. Liability duration, 2 years on 180 million. Okay? So we know that the gap is 1 year. 3 years minus 2 years. But we got a problem because we have more invested here than here. So the gap is actually higher than it looks. If interest rates rise, okay, that would be a good thing because we have more money invested in here. Okay? Let's take a look at so let's plug this into the formula. Okay? So we have 3 years minus 2 years times 180 divided by 200. Okay? That's how the formula needs to look. Okay? And I'm not sure, looks like I didn't maybe I didn't get my brackets right. Yeah, I didn't get my brackets right. Need a bracket right here, and then right here. Because what we're going to do is we're going to do this first, then we're going to multiply it by the 2 years, and then we're going to subtract that from our 3-year duration for our assets, which indicates that the gap is wider. So let's do that, okay? So we know if we don't make adjustment, we know the gap is 3 years minus 2 years. It's 1 year. Okay? But when we multiply the 2 years by the 180 divided by 200, we get 1.8, and 3 minus 1.8 is 1.2. So the 1.2 tells us the gap is actually higher than what it appears to be without the adjustment. Without the adjustment, the gap appears to be 1. With the adjustment, because we have more money invested in assets, the gap is wider. Okay? And so if we're going to adjust, if we want to close the gap completely, we don't close the gap by 1 year. We must close the gap by 1.2 years. Okay? Because we have more money invested in assets. So it's a positive gap. Assets are longer than liabilities. That's a positive gap. But if we're trying to close that positive gap, we have to account for the extra $20 million invested in assets over liabilities. And this is how we do it. Okay? So yes, you'll have an example to work. But I want you to understand the concept that it is the length of the duration and it is the amount invested. The book calls it volume, dollar volume, invested. Both the length and the volume impact the gap. All right. Once again, my animation has left me. All right, we're getting close to the end here. We got 2 more slides. 34, 35, 36. We got 3 slides to do. Okay. So we can compute the change in owner's equity due to a change in rates. Just like we could forecast the change in net interest income, we can forecast the change in owner's equity. So the change in owner's equity, let's see if, so the change in the dollar value of owner's equity, what will happen to owner's equity if interest rates change, is equal to the opposite of the duration of assets times the percentage point change divided by 1 plus the beginning rate times total assets. That is in our numerator. And you're going, wow, whoops, this looks so complicated. It's not. And I'm going to allow you to have a card, and you can put the formula on a card. Then from that, you subtract the average duration of liabilities times the percentage point change divided by 1 plus the beginning rate times total liabilities. Doing this will help us forecast how our net worth or owner's equity will change if rates change. So let's look. A bank has $120 million in assets and $100 million in liabilities. Their assets have a weighted average duration of 3. Okay? What do I mean by weighted average duration? Well, you got $120 million worth of assets. This could either mean that every one of the assets has a duration of 3, but the chances are